Bitcoin's price is a total roller coaster. One day it's soaring, the next it's plunging, and it almost always leaves people asking one simple question. So let's pull back the curtain and really break down the powerful forces that make Bitcoin's price move so dramatically.
Yeah, this is the question, isn't it? You wake up, you check the charts, and boom, everything has changed overnight. It can feel completely random, but I promise you it's not. There are these powerful layers at play, and in this explainer, we're going to peel them back one by one.
All right, first up, we've got the most visible and, honestly, the most immediate driver, the psychology of the market. This is all about human emotion, right? It's a collective mood that can shift in an instant. At its core is this idea called market sentiment. The best way to think about it is like the financial world's gut feeling. This has nothing to do with spreadsheets or technicals. It's all about raw emotions. Hype, fear, greed, all fueled by whatever the latest headline is. And this sentiment is a powerful two-sided coin. Let's say you get some great news, like a Bitcoin ETF gets approved. Suddenly, FOMO, that's the fear of missing out, kicks in hard. Everyone rushes to buy and the price just pumps. But the opposite is just as true. A single piece of bad news, like a major hack or a government ban, triggers instant panic. People race to sell, and that causes an immediate dump. But emotion, that's really only the surface. If we dig a little deeper, we find our second layer, this massive economic engine that's powering global markets. We're talking about decisions made far, far away from crypto, but they have these huge ripple effects that hit it directly. And right at the center of that engine, you've got the U.S. Federal Reserve. Because the U.S. dollar is the world's reserve currency, any choice the Fed makes on interest rates sends shockwaves through literally every market, and that includes Bitcoin. And it all comes down to a surprisingly simple relationship. See, when the Fed lowers interest rates, the dollar gets weaker. So investors start hunting for better returns in riskier assets, and a lot of that money flows into Bitcoin, causing a pump. But when the Fed hikes rates, suddenly safer things like government bonds look way more attractive. So investors sell their Bitcoin and move to safety. And that leads to a dump. Simple as that. Okay, now we get to the third layer, and this is where things get really fascinating. We're talking about the hidden hands moving behind the scenes, these massive players and automated systems that can just trigger chaos in minutes. First, you got to meet the whales. Look, these are not your average investors. These are individuals or groups holding so much Bitcoin that a single one of their trades can create waves across the entire market. Their power is pretty simple and direct. When a whale decides to buy a massive amount, that sudden surge in demand sends the price absolutely flying. But if that same whale decides to sell, the market gets flooded with supply, and the price can tank just as fast. It's pure supply and demand, just on a totally colossal scale. But it's not just about what one person decides to do. There's a powerful, automated chain reaction that can take over, especially in the futures market. And this is where things can get really explosive. It's called a liquidation cascade, and it is a terrifying domino effect. It all starts with one big price drop, maybe a whale selling. That first drop triggers automated stop-loss orders from thousands of other traders. This new wave of selling pushes the price down even more, which, you guessed it, triggers even more automated selling. It becomes this self-feeding waterfall, a cascade of forced liquidations that can crash the price with unbelievable speed. Okay, finally, let's zoom all the way out to our fourth and final layer, the global game board. Because Bitcoin doesn't exist in a vacuum, right? Its value is tied directly to world events, politics, and regulations. Government decisions are a perfect example here. When a country like El Salvador adopts Bitcoin as legal tender, it gives it this massive boost of legitimacy, and the price reacts really positively. But when a major player like China bans crypto mining, it creates widespread fear and uncertainty, causing the price to dump. And this goes way beyond just crypto-specific laws. Any major geopolitical event, a war, a trade dispute, an economic crisis, sends investors scrambling. And the big question in those moments is always, is Bitcoin a safe place to hide from the chaos? Or is it just another risky asset to run from? The market's answer can swing the price violently either way. So, after peeling back all those layers, what's the big takeaway here? Let's put all the pieces together and see why Bitcoin is so notoriously volatile. It's really the chaotic collision of these four powerful forces. At any given moment, you have the daily emotional swings of market sentiment smashing into the slow, heavy pull of big economic decisions from the Fed.
And on top of that, you have the sudden sharp shocks from whales and liquidations, all playing out on this constantly shifting global stage.
Ultimately, it all just boils down to this fundamental truth of crypto. It is high risk, high reward. The very same forces that can create those incredible gains are the exact same ones that can lead to dramatic losses. The volatility isn't a bug, it's a core feature of the whole thing. And that's exactly why understanding these drivers is so vital. Look, it's not about being able to predict the future. It's about understanding the game you're playing. Just knowing what can move the market, that's the foundation of managing your risk effectively. Which, of course, brings us back to today. Now that you understand the forces at play, the sentiment, the Fed, the whales, and the world stage, what do you think? Is this latest price swing just more noise, or is it the signal for something much bigger on the horizon?